Welcome to Markets Now. I'm Michelle Rook along with Dave Chatterton with Strategic Farm Marketing. And we had a higher close in pretty much everything except for the cattle futures today. And Dave, wheat, the price leader, and let's talk about kind of what pushed some of the short covering that we saw in the market. Maybe a little bit of war news or some more headlines.
Yeah, definitely. We kind of floating all boats here today and leading to a higher close across the entire grain floor today, Michelle. And that came after, a mid-session news blurb from the Lloyd's Group out of London that a general cargo ship had encountered a seaborne mine en route to Ukraine. Now, this was a boat that had left from Turkey. It was crossing the sea. It was outside of the corridor that's recently been outlined by the Ukrainian government as what they call the humanitarian corridor. But the fact that the ship did hit a mine, it wasn't seriously damaged. It did resume its journey here, but definitely enough to get the attention of the trade. This comes just a couple of days after the UK government warned that Russia would likely use seaborne mines to kind of curtail any grain cargoes coming out of the Ukrainian Black Sea port. So trade very attuned to what may or may not happen there. This, whether this becomes a one-off incident or is the first of many to come, I guess is a question that we're going to answer. But certainly some shorts ran for the sidelines here, considering the length of the size of the fund short that we have in corn and wheat of late here, and the sellers that have come in the last number of sessions. We saw many of those head to the sidelines here and get prepared for the weekend.
So, Dave, do you think it would take a bigger escalation of the conflict over there for the shorts to start blowing out of this short position they have or not?
Yeah, I think that's the case, Michelle. I think the weak shorts are probably gonna head to the sidelines just for a little bit here and let the dust settle. But in all essence, until we get a situation where a grain vessel is struck and seriously damaged inside the corridor that's been outlined, I think it's chances are this is probably going to blow over. Definitely a fluid situation as this Black Sea and this Russian-Ukraine situation have been since day one. But I think for right now, the odds are going to probably favor that. We'll see how the market wants to close on Friday and how much premium they want to continue to put in or keep in the market.
And as you mentioned, corn got some spillover support from that rally in the wheat market, but we got above some pretty good chart resistance here. Can we keep this momentum going?
Yeah, really good question, Michelle. And I hope that we do. As you mentioned, we got a little bit of an upsloping channel in that December corn chart. Same for March. We broke above that and closed above that on Thursday. So key would be confirming that here in Friday's action and going into next week. I think the question remains, we're in the prime time, this first half October time period of carving out a seasonal low here or a harvest low and seeing the corn market put in maybe a 30, 35, 40 cent average type of a rally. We still have some hurdles to do that. We have a USDA report that's going to be very important next Thursday coming up that we'll have to get past. The market is focused on U.S. yields and, of course, what that export demand figures are going to look like from the government. So I know that we can sound the all clear here, but certainly the technical action in corn is looking better than it had a few weeks ago. And I think for what we would have expected at this point in harvest.
Yeah, a close above $5 would certainly be nice here. Do you think that, this corn market, which has stayed stronger, better than we anticipated with the 2.2 billion bushel carryout, is it just the perception that maybe yields are not as big as we thought, or is it end user demand picking up?
Yeah, I think it actually is exports, Michelle, to be honest. When you look at the export comparison, beans have kind of gotten the short end of the stick here. U.S. soybean exports marketing year-to-date sales compared to last year are 34% lower year over year. The government is calling for a 10% year-on-year decline. When we look at corn sales, same thing this year at this point in the marketing year versus last, down only 3%. So they've held their durability just a little bit. This just call it a 2+ billion bushel carryout. It's kind of been well-traveled news here. Now, certainly to your point, there's an active yield debate going on. And I think after the September crop report or the September WASDE report, certainly the trade saw that yield from the USDA probably going down again in the October report, which we'll get next week. I think in the last few weeks, there's been enough of a kind of a mixed idea or improvement over pre-harvest ideas on yields that the trade is now looking at steady to maybe even a little bit slightly higher corn yield when it comes out next week. We've seen a few private analysts lean that way this week. So going to be an interesting report, and we'll see how things shake up going into it.
Yeah. So you mentioned soybeans have seen a little bit of hedge pressure. We were up today kind of following corn and wheat, but hedge pressure, and you mentioned the export picture as well being kind of bleak here. So even if we get these short-term pops, do you think there's a lot of downside risk left in this market?
Yeah, I don't know that there's a ton of downside, but I think it's been a little bit of a struggle for beans through this week when in our part of the country anyway. So I'm talking about Central Illinois, maybe Central Indiana. Definitely a bean week. We saw some of the corn processors actually raise their short-term, spot cash bids, trying to attract a little bit of stuff. Now we've had a rain here midweek, so the focus, or the harvest pressure will let off a little bit. But certainly, I would look for a big corn harvest week next week and beyond. That's going to give the beans a little bit more room to start to maneuver and lessen up on the hedge pressure just a little bit. I don't want the export situation. China will return from their Golden Week holiday here tomorrow. We'll see how they, if they come forth with any new sales and interest in U.S. soybeans. But for right now, I think it's a little bit of a struggle. We continue to see both Brazil and Argentina offer values, landed into China that are cheaper than what the U.S. offers are coming out of either the Gulf or the PNW.
And the cattle market seeing some pressure again here. Is this been part of a healthy correction because we were so overbought, or, did the funds keep liquidating here because it seems like they have this risk off mentality right now?
Yeah, another kind of a tough day here, kind of struggling to get back on our feet from what's been a very strong uptrend in that cash cattle market. But I think it's, as you indicated, Michelle, I think it's really kind of overdue. I think a good, kind of healthy correction here would be a positive thing for the marketplace as we look forward. We have seen some weakness in the cash. We've seen some weakness in the live numbers as well as the cutouts here. But looking forward here, I think the fundamentals for the cattle market remain, pretty supportive into the fourth quarter and into early next year. So with that, hopefully, probably I could see the market struggling here for the next 2, 3, 4 weeks as we wait on some of this holiday demand from both the U.S. and the Asian and the foreign markets to shape up a little bit. But I think once it does, we're probably on more stable footing. In the meantime, we've had a pretty large fund long in this market for quite some time, probably due for a little bit of a turnover here. And, wouldn't take that as a sign that things are falling out of bed or that we're going to simply reverse the trend and go lower for a number of months here.
Are you concerned about the macroeconomics weighing on this market, though, in terms of demand because of, what we have seen with this, rally in the bond market, what's going on with the stock market and whatnot?
Yeah, I mean, you definitely can't discount that. I mean, the retail demand here is a a pretty well discussed, debated topic here of late, and certainly with the issues that are happening in these macro markets, whether you look at interest rates, mortgage rates, credit card debt. I read something the other day about there's 40 million U.S. student loan payments that will resume here again next month at $400 a month, taking $16 billion out of the consumers' pockets every month. So certainly something that we have to be concerned about and be watchful of going forward. I don't know that those numbers at the retail level that we've seen have changed a whole lot yet, but we are watching for that and watching it closely.
And the higher day in the hogs, was that just short covering, Dave, or was that the strong exports that we had this morning?
Yeah, strong exports were a great sign. I think, we're seeing some good strength here when you look at those decent deferred contracts. Started, the lower covered. We had a nice rally today. We took out everything. We covered that gap from Monday that we left, Michelle, after the hog and pigs report. I think looks like that the report data now is probably fully digested and we're kind of ready to move on just a little bit, if you will. We've got a very modest fund long in the hog complex, and it's moving back to the upside here, as we go into a seasonal demand period.
Yeah. Certainly good to see that chart gap area filled today, though. All right. Thanks for joining us, Dave Chatterton with Strategic Farm Marketing, and that's Markets Now.